Welcome back, dear traders. Fed policymakers are obliged to refrain from any public comments ahead of the policy meeting on December 13. So, market sentiment will depend on a response to economic statistics. The first week of December is going to be loaded with news in the economic calendar. The Fed's decision on the interest rates will be the crucial factor for investors to revise their portfolios. Wall Street showed the strongest performance of the year in November. Hence, the stock market was overwhelmed by euphoria. It was supported by expectations that the Fed's aggressive monetary tightening has been completed and that it brought the U.S. economy to a soft landing. In other words, inflation is now on its way to the target 2% rate without a serious downturn in the economy and the labor market. Meanwhile, the FedWatch tool logged some changes in the market consensus. Previously, the barometer indicated a 100% likelihood of a pause in the Fed's monetary policy on December 13 and January 31. Now, 2.5% market participants expect a rate hike. The opposite trend showed up in a parallel. And today, 14% investors believe that the regulator could venture into the first rate cut at the first meeting in 2024. In his speech on Friday, Jerome Powell tried to moderate both hawkish and dovish expectations, and the Fed's chairman warned that it was too early to speculate on the issue of rate cuts. Initially, his remarks came as a bombshell, and the benchmark stock indexes went down in a few minutes after the speech. For your reference, a few weeks ago, Jerome Powell defined the Fed's monetary policy only as restrictive. On a Friday, he confessed that the measures imposed by the central bank made the policy restrictive enough, and this phrase was treated by the market as a dovish signal and enabled a downward reversal in stocks. All in all, market expectations of a further monetary policy of the U.S. Central Bank did not change considerably. As a result, the S&P 500 closed the last trading week at 4,594, the highest level since the beginning of the year. The weekly growth was 0.8%, and this week U.S. retailers such as J.P. Smucker, Lululemon and Dollar General are due to report their corporate profits. Investors will take notice of quarterly reports by semiconductor manufacturer Broadcom and gaming merchandise retailer GameStop. The shares of the video game company recently jumped by more than 20% in a single session. The assets more or less related to artificial intelligence rose with interest among investors. For example, amid the AI hype, shares of the application developer C3.ai have rallied by 175% in a year, and these stunning examples were recorded in November. Of course, the main catalyst for market sentiment will be reports on the U.S. labor market. The employment report by the private ADP payroll processor and the official non-farm payrolls for November. The economic calendar is empty today. Thus, the stock market is set to trade quietly. Futures on the S&P 500 are expected to decline within the intraday corridor between 4,581 and 4,604 points. The US dollar is clicking into gear in the New York pre-market. On a Monday, the greenback managed to recoup some losses incurred in the last 3 weeks. Moreover, some analysts do not rule out that the US dollar could catch the second wind and take advantage of the situation. They think it's that the greenback needs more fundamentals for its weakness than just expectations of the Fed's rate cuts. The bearish outlook should be propped up by strong performance of economies and currencies beyond the United States, and this state of affairs is unlikely nowadays. So the US dollar is expected to follow the overall downtrend, interrupted by periods of its reinforcement. Today, its index is trading higher within the intraday corridor between 103.00 and 103.50. Its Canadian counterpart is wound down by a few factors. To begin with, the crude oil, Canada's major export commodity, is sliding in the light of the OPEC Plus summit. Second, the market has already priced in Canada's strong employment data, so its positive influence is over. Third, and above all else, the Canadian dollar is giving in to its stronger American peer. As a result, the USD CAD pair opened today higher at 1.3540. The intraday corridor for the instrument is seen between 1.3480 and 1.3550, while fiat currencies are losing ground against the firm greenback. The number one crypto is extending its strength. Bitcoin has tested record high levels since April 2022 and rose to about 42,000. Remarkably, the crypto appreciated by 13% last month and has surged by an incredible 150% since the beginning of the year. More highs are yet to come. Cryptocurrencies rally is fueled by expectations that the Federal Reserve would soften its stance and adopt a dovish monetary policy. However, the underlying reason behind growth in the crypto market is the anticipation of launching first spot Bitcoin ETFs in the United States. Such hopes intensified after the U.S. Securities and Exchange Commission had an appointment with the BlackRock and Grayscale executives. The regulator is widely expected to approve applications by these firms for opening Bitcoin ETFs on the Nasdaq exchange in January 2024. And in this context, Bitcoin maintains bullish momentum, though the price has entered the consolidation stage after the opening bell in the United States. The token is likely to trade in the intraday corridor between $39,440 and $42,073. We hope that our video reviews help you find beneficial market entry points. Welcome to leave your comments and feedback. Thank you for watching and see you online tomorrow.